In late 20th century, while European nations were recovering from the World War II, many Asian nations just started full-scale industrialization. Unlikely to Europe, Asian powerhouses practiced isolationism for 3 centuries. As a result, these nations in 20th century had only little experience in industrialization and finance. At the early stage of information revolution, such experience couldn't be shared easily, and the only way to learn was trial and error. Despite of this weakness, they were having remarkable economic success in late 20th century. Thanks to cheap wages, manufacturing industry began to settle in these nations. Southeast Asian countries such as Thailand, Malaysia, and Indonesia developed light manufacturing industry. Hong Kong and Singapore became Asian financial hub, and South Korea developed heavy industries, seeing Japan as a role model. But they had common characteristics. First, they were heavily relied on import and export. Their domestic market was not yet developed enough to consume their products and services, so it was impossible to operate their industry without foreign market. Second, because of the short history of the industrialization, they didn't have enough time to accumulate capitals. This meant that they had weak financial fundamental and rely on foreign investment. There was another characteristic. Their government often interfered or even directly controlled industry, especially in financial sector. For example, in Korea 1960s, the government needed heavy industries to build tanks and warships. But transforming agricultural nation to manufacturing nation was not an easy task. Korea didn't even have a functioning steel mill and lacked basic infrastructure like railroad, highways, and ports. This required enormous investment that no one in Korea could afford. When Korea asked the United States and the World Bank for funds, they rejected Korea's request for loans. This problem was solved by Japan's compensation for past colonial rules, but this was how the world saw Korean economic development. In Western standard, Korean way of economic development was suicidal. Therefore, no sane-minded banks were willing to invest in Korea. To maximize the effect of limited fund, government often forced banks to lend money to specific companies and protected those companies from the other competitors. In 1970s, fortunately for Asian nations, US dollar was no longer pegged to gold, and getting loans from the United States became much easier than before. This allowed governments to control various industrial sectors at once, and it led Asian economic boom. However, it also caused corruption, poor risk management, and minor diplomatic friction with others. But in 1990s, the situation had changed. As the Soviet Union collapsed, the United States got rid of its biggest existential threat against them. Many Asian nations lost their strategic value for the United States, and this could mean there wouldn't be unconditional support like before. In fact, the United States had a good reason not to help these nations. Since 1980s, the United States manufacturing industry was losing its edge against Japanese products. So in 1985, by signing Plaza Accord, the United States managed to cripple Japanese manufacturing industry. However, this only helped other Asian nations. Japanese banks and financial institutions invested on these emerging markets for higher return, and the United States was looking for a chance to change this situation. There was another big change in 1990s. Technological advances was changing the shape of global economy. With new technologies, new kind of service industry boomed, such as Windows and Office from Microsoft, and movies and animations from Disney and Hollywood. These new kind of products dragged the US dollar back to United States, and because of this influx of the US dollar, United States raised interest rates to stop the inflation. And naturally, this interest hike made investors pull money from the emerging markets such as Korea, Thailand, Indonesia, and Malaysia. New technology also brought big changes in financial market. Thanks to computer engineering, even minor financial institutions could utilize computers, and transactions through internet became widely popular. And this powerful tool became a crucial factor in Britain's Black Wednesday, where a group of hedge funds defeated the Bank of England. Clearly, 1990s financial market was very different from 1980s. There are another case that show how powerful financial institution became. In January 1st, 1994, NAFTA was signed. This allowed American manufacturers to move to Mexico, and this could be the stepping stone for Mexico to be a developed nation. It attracted foreign investment, so Mexico could build infrastructures for growing industry. But in December, political assassination and instability worried investors, pulling money from Mexico. The problem was, Mexico was practicing fixed exchange rate, so anyone with Mexican peso could get US dollar with fixed exchange rate. Those who learned the lessons from Black Wednesday in Britain knew what this meant, and converted Mexican pesos to US dollar in a hurry. The central banking system was paralyzed, and Mexican government was not prepared for this crisis. Mexican peso lost nearly 50% of its value, and Mexican government faced an imminent sovereign default. At the end, 6.2% of Mexican GDP was wiped out, and was later bailed out by the United States, but there was a heavy price for the bailout. Meanwhile, another historical event had happened in Asia. A great earthquake struck Japan, killing 6,000 people. Japanese industry was crippled, and this could impact on global supply chain. But in 1995, Japan was no longer a challenger against American economic hegemony, and United States were more worried about trade deficit from other Asian nations. So, United States allowed Japan to depreciate yen for quick recovery, and this was practically a death sentence for Thailand manufacturing industry, since Thai baht was pegged to US dollar and competing against Japanese products. Soon, Japanese industry quickly recovered and threatened other developing nations. Hedge funds did not miss sudden change in Asian market. For them, it was an attractive playground. Thailand and Hong Kong practiced pegged currency and vulnerable to currency attack. Other nations also heavily depend on US dollars, which was slowly slipping away from foreign reserve because of high interest rate in United States. And there was another great uncertainty in Asian market. Hong Kong was supposed to be returned from Great Britain to China in 1997, and the world was concerned at Hong Kong's uncertain future under a communist regime. Hong Kong was financial hub in Asia, so if the hedge fund create financial panic in Hong Kong, they could bring down entire Asian market. The attack of hedge funds started in May, 2 months before Hong Kong's return. After agonizing 2 months of defense, Thailand ran out of foreign reserve and its pegged currency system collapsed. Thai baht plummeted 20% immediately. Losing 20% of currency value was already bad, but the Asian financial crisis had just started. Thailand banks stopped extending the loans, and Thai companies suddenly had to sell everything to repay the debt. Thai stock market and real estate market crashed. Many Koreans and Japanese banks who gave loans to Thailand were in dangerous positions since Thailand had no US dollar to repay the debt. Fear began to spread, and investors started pulling money from Asian market, and the hedge funds attack became stronger. Despite of that, many Asian people outside Thailand were not aware of the current situation, and politicians wasted precious time to prevent the crisis. 2 weeks later, many financial institutions noticed what was happening in Asian market was not just an ordinary fluctuation, and credit rating began to drop. Asian currency value plummeted, and foreign debt became difficult to pay back. Singaporean economy entered recession. Korean government still did not see the current situation and tried to defend the currency exchange rate by spending foreign reserve. Malaysian government implemented heavy penalties for foreign capital movement. Hong Kong raised the interest rate to defend the pegged currency system. However, in August, these measures proved that they were not enough to stop the crisis. When Thailand begged IMF and Japan for emergency loans, Korea had depleted most of its foreign reserve, just like Thailand had faced this issue a month before. Its only way to gain US dollar was export, but its manufacturing power couldn't compete against Japanese products, buffed by 20% depreciated yen, and the export performance was not enough. Even worse, many Korean banks borrowed US dollar from Japan and lent it to Thailand for higher interest rate. As Thai companies went bankrupt, Korean banks had to take the loss from Thailand while repaying US dollars to Japan. Other Asian nations were facing similar situation. At this moment, people noticed numerous companies were going bankrupt, and thousands of people were losing jobs. They still believed there was something government could do to revitalize the economy, but the truth was, their government were not even sure they could pay their own debt. The whole nation could go bankrupt. But as it was mentioned before, their industrial structure was heavily relied on foreign market to import resources. In other words, they needed US dollar to operate industry. In 1997, Asian nations must operate industry to repay foreign debt. But they didn't have enough foreign reserve, meaning it was impossible to repay, causing chain bankruptcies. In the nation without any natural resources, such as Korea, this was basically death sentence to its whole industry and economy. Without oil, the entire industrial chain would collapse, including power supply and transportation. In the nation with food sufficiency is less than 50%, such crisis would bring mass starvation. And this desperate situation continued more than 6 months. The only Asian nation who was not suffering foreign reserve crisis was Japan. Despite a declining economy, Japanese had the most US dollars in foreign reserve in the world. In fact, Japan was partially willing to lend US dollars to these nations, and whole Asian financial crisis could have been stopped at this stage. But if Japan saved these nations, the entire Asian market could be under Japanese influence. And this was something the United States couldn't tolerate, and pressured Japan not to help these nations. It was a great opportunity to demand these nations to stop protecting their industry and unfair trades. However, the United States changed its attitude after October. The financial crisis in Asia was now causing domino effect on New York Stock Exchange market, and it had to be stopped before triggering global financial meltdown. The sign of meltdown didn't appear only in New York Stock Exchange market. In Japan, Sanyo Security went bankrupt in November 3rd. Hokkaido Takushoku collapsed on 16th. On 24th, Yamaichi Security closed its business. As bank faced crisis, all Japanese commercial activity crippled. Fortunately for Japan, the Bank of Japan was still holding large amount of US dollars, and the only problem was how to perpetuate Japanese economy with this large amount of US dollars and minimizing the side effect. Meanwhile, another sign of meltdown appeared in Russia. As many Asian nations couldn't import oil, the price of crude oil dropped. Russia's economy heavily relied on oil export, and the Asian financial crisis dragged the Russian economy to its downfall. In December, Korean government received funds to avoid bankruptcy, but there was a price for that. Korean economy was no longer under control of Korean government, and IMF took charge in Korean economy, focusing on protecting the investors instead of protecting the industry. Its policy improved transparency and financial stability in Korean economy, but it left millions of unemployment and chain bankruptcy. Thailand too received emergency funds from IMF, but Thai government had to agree to let companies to go bankrupt, similar to what Korea agreed. However, both Korea and Thailand were not sure if IMF actually had ability to recover their economy, since their overly friendly attitude toward investors and hostile attitude toward industrial sectors. In Korea, 10,000 people will lose jobs every day under IMF rules. This policy from IMF scared Indonesia and resulted reluctant attitude toward IMF's help. Indonesia was facing imminent food shortage, and Suharto, the leader of Indonesia, was unwilling to give up his interest in Indonesian economy. In March 1998, riot occurred in Indonesia because of skyrocketing price of goods including food and fuel. IMF eventually settled this matter in May, but the riot continued. When Korea and Thailand surrendered their economy to IMF, Hong Kong was still fighting against the hedge fund, but the hedge fund in 1998 changed their strategy and resumed shorting against Hong Kong dollar. Just like before, Hong Kong raised interest rate to defend the foreign reserve. By raising the interest rate, little money from market and borrowing money from bank become expensive, making short selling unattractive and more risky. But this time, short selling didn't stop despite of high interest rates, and Hong Kong's high interest rate started crippling its own financial market. Stock market plummeted, and hedge fund gained profit by short selling the stocks. As the hedge fund started performing organized attack in both currency and stock market, Hong Kong now had to decide whether it is going to defend the pegged currency at cost of its economy. At the end, Hong Kong chose to defend the currency. The interest rate went higher than 100%. It was peaked at 280% at some point. Its financial market was paralyzed, and to defend the stock market from the hedge fund, Hong Kong bought stocks to save companies. This attitude assured many investors that Hong Kong would defend the pegged currency system at all costs, and it was able to defend foreign reserve from the currency attack, sacrificing small business. The Asian financial crisis destroyed national pride and economic confidence in Asian nations. Millions of people without financial knowledge suddenly lost their houses, business, and jobs, and their trust on their government collapsed. Many companies and banks were sold to foreign buyers. The GDP of South Korea, Thailand, and Indonesia dropped 35%, 40%, and 80%. Considering the United States GDP fell only 6% in 2008 and 30% in Great Depression, Asian financial crisis was more than a financial disaster. Whole industry was paralyzed and people were concerned about the very sovereignty of the nation. And its aftermath reshaped the industry, economy, finance, and political atmosphere in Asia. The most valuable lesson from the crisis was that American economic boom will lead high interest rate in the United States, and this could be a trigger for catastrophe in developing world's economy. This lesson will cause another crisis 10 years later. However, the financial crisis was not over yet. Its momentum was too big to be stopped by the rescue package at this point. As Asian economy collapsed, oil price plummeted, and this would cause another crisis in another nation and the international bond market.